U.S. futures point to a sharply lower open on Wall Street as Operation Twist fed more fear into the market, and there was more bad news out of the Eurozone regarding Greek debt default. Stocks tumbled Wednesday following the Fed's gloomy assessment of the economy, acknowledging that America's economic slowdown is likely to continue for some time. Oil tumbled as well, but the dollar held its own against the euro. Hong Kong's Hang Seng led overseas markets lower with a near 5% dive, while European markets are all down over 4%. I'm Jill Malandrino, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer with T3Live.com.
And I'm Jill, and together we bring you the morning call. Wow. Hong Kong is down over 5%, or finished down over 5%. Europe is down over 4%. Market got crushed yesterday into the close. I feel like every time it's my turn to do the morning call, the market decides to go parabolic. So what's going on here?
Well, it's more like parabolic to the downside. There was a lot of writing on the wall, and I don't want to, chest beat. I don't want to go over what has happened because there's a lot to go over today. But if you connect the dots, you're always going to be safe in this market. Starting on Tuesday, you had that push-through failure in the equities. You had in the highest rated stocks, we had our go-to list stock. They all tried to make new highs, and they couldn't hold the momentum high. So that was sell signal number one. Tuesday's push-through failure, get back down to tight. Like tight meaning no loose shares. No shares out there that you don't want, just a tier one, get rid of your momentum longs. Then yesterday we came in and we talked about the Fed. Everyone was talking Operation Twist. What could they do? How could they save the day? And meanwhile, the headlines have just been plain nasty.
Right.
So 1188 to 1192 was the last technical level because I can't trust the headlines, the fundamentals. Everyone always has their opinion. The market never lies. If you look here at the chart of the S&P, let me show you what we're talking about. This was that push-through failure Tuesday at the upper end of the range, right into 1225. Let me give you a closer look. Okay, then this was the line we drew yesterday saying if we start breaking below 1188, 1190, you have to go from neutral to negative. Perhaps get the cash, and most quick traders actually got a little short after the Fed came out and downgraded the economy and no longer uses the transitory term. And now we're right at this, it's not even funny, we're right at this uptrend line that we're opening below. I'm going to be watching 1120 early this morning to see if we can get any kind of bounce, looking at any kind of leaders. But chances are, I do think that this bear flag that's been being built since early August is on the way to be resolving to the downside. And Jill, we've had many indicators showing us that this could happen and this could start getting in motion.
Right. Well, I think Operation Twist, it was no surprise that this was going to happen, but I think the commentary coming out of the Fed, people are like, wow, the emperor really is not wearing clothes, and the situation is not that good. Then you also have, they're talking about Greek default again. I think it's a matter of when, not if at this point. So, we just have to work through these issues and break through some levels. And,
just the headlines are just that bad.
The headline risk is.
And then I even read today that they voted on a stopgap in order to increase the funding, more debt ceiling talk, and it didn't go through. Now they're saying September 30th, the government might shut down, and we all know what happened in the headlines the last time. They couldn't come to terms, and people are just sick of bad policy, sick of poor leadership, sick of Washington, and sick of what they're hearing. So that's why you have to take control of your own life by not living above your means, and also don't trade out of bounds. Don't do trades that make you uncomfortable. Don't be in the market if you need to be sitting in cash. These are very dangerous times. If you take a quick look at the chart one more time, if you look here on the S&P, if you look at these macro patterns, first macro pattern I showed you this summer was the head and shoulders top that triggered at 1250. This was a way out, and now you have a bear flag. If we get continuation, which it looks like we're happening, or it's starting to happen, you go to your weekly, and there's no reason whatsoever that the S&Ps cannot, get to 1010 to 1040, which is the support from last summer, which would be about 96 to 9800 on the Dow. So just make sure, you have a plan and you're ready to act fast, because those that have done that, they're sitting in a lot more cash than others, and the volatility will be an opportunity for them.
Speaking of leadership, let's go and check the sector spotlight and talk about some strong sectors and some weak sectors, starting with the Qs. Mega Cap has really been a leader.
They've been holding up, but they also on Tuesday gave you a push-through failure, and they caved at the end of the day. If you look at the Qs here that have been acting very well, but that's why we use a tier system, you go to your daily chart and you will see that, I'll get you even closer here, an outside day is when the indice pushes through a prior high, closes on the low. That is a sell signal, especially after a huge move like we've had. Yesterday you had your follow through, or to the downside if you were short, or this was a way out, and then we closed at support. So we're opening lower. I would say the Qs watch this 54. This is a key area. And even strong sectors that try and hold up, if they break rising channels, could play catch up to the downside very fast. If you had to be in one area and look to one area, at least the NASDAQ is giving you the benefit of the doubt.
Right. Another sector that showed relative strength was the RTH, the retail ETF.
Yeah, everyone's been saying, why is this sector holding up? You know what? Don't fight it until it changes. And you saw a bit of a change again on Tuesday. I hate to beat a dead horse, but you have to notice these things. RTH, they have a rising channel also. It too put in an outside day, right? Pushes through, closes lower into some big, resistance. And look how harsh this was. And now it's going to be opening up probably around this 102. I would say if you're in your tier 1 and you're comfortable, that's fine. But if the RTHs start to break below 102, it could get ugly. Some might look to buy some support here considering the move down. I think it's worth a look, but you have to look at the whole landscape in front of you.
Moving on to a few weaker sectors, let's take a look at the XLI, the industrial space. Last week we saw a pretty decent move in the industrials and the transports, which are important indicators for the market. So this move
they were actually strong for 2 days.
Right.
And they weren't leading the markets, and we talked about how, the market's trying to broaden out, so maybe they'll take some of the weaker sectors. But the XLI and the materials and the industrials were what led us lower and gave us information that the spiders and the diamonds were going to trigger that head and shoulders pattern. And now they've been so weak that this is giving us some indications for the downside follow through. So if you look here at XLI, you will see, look at this. This is not a strong sector. You saw the Qs all the way up through resistance. XLI, all it did is play a little bit of catch up to the downtrend line. Some groups actually penetrated this. So to me, this is still weak. I think that you have one line of defense here down at 29.50 or 29. But if this were to break, you go to the weekly chart, and this too could look a lot lower, and you could see a move down to 26. And then that would be an area I would watch if this resolves to the downside, which I think it's in motion for.
And rounding out with the financials, the XLF, not much to really say there. Moody's yesterday downgraded Wells Fargo and Bank of America.
So just more bad news, which we've been getting so much of. And yesterday we talked about the XLF as being one of those leading sectors to watch in front of the Fed news to see if they start going lower. I talked about how Goldman Sachs held 100 one time. If it goes below 100, psychologically you're going to see pressure in the market. It closed below 98. Morgan Stanley was at 3-year lows even before the Fed started speaking. So there's some clues to start loosening up, but you have to look for these clues. So if you look at the XLF, you will see right now on a macro level, it broke that 12 that we were talking about, and now you could see a move to most likely, I would say a shallow move down to this about 1080, and then from here, there's really nothing in its way down to almost 950. And if you look at the daily chart, it's even more ominous. It actually, if you cheated a little bit, right? I drew this yesterday. I drew this little minor wedge. I said if it starts breaking below this 1245, get out of the way. Don't even wait for $12.
So relative strength in a pretty terrible tape. We're looking at the Qs, RTH, industrials, and financials we're still not loving. We're going to take a quick commercial break, and when we come back, we're going to jump into the trenches.
When the closing bell rings, it's not quite time to run off to happy hour.
Good afternoon, Scott Redler, T3 Live. Welcome to today's recap.
Before unwinding, take stock of the trading day. What's the complexion of the market? Which trade from the morning call triggered? What sectors are in play? And where will the opportunities be tomorrow? Scott Redler covers it all in the T3 Live Daily Recap video. The T3 Live Daily Recap airs every day after the close.
As far as this market's concerned, we got to take off those glasses.
Welcome back to the morning call. We're going to jump into the trenches and go into the oil sector space. Again, the oil group having a tough time as well with overseas concerns and with the U.S. domino effect with the economy here.
Yeah, this group has been having concerns, but for technicians, it hasn't been a concern because it's been helpful. It's been helpful to see a group that used to be so strong, so weak, to give us some clues that we can go lower. The OAHs have been in this lower wedge, and it actually resolved yesterday, well before the diamonds and the spiders started today. So that gave you some clues to be a bit more cautious. If you take a look here at the OAHs, let me show you. Look at this perfect wedge. Never even tried to get above it. It was at the lower end of the wedge going into yesterday while the spiders were testing the upper end. And look how it broke well before the Fed started to make their statements at 215. This is just where they got its follow through. So if you look at the weekly chart, this can go a lot lower. This is just starting to go with the continuation pattern. This was your first move, the pole. Here's your flag, starting to go to the downside. Next big level here could be well below 110. And I also talked about a lot of the stocks in this group, stocks that you could short, stocks that you probably shouldn't be long because they're below all the moving averages. They're not showing technical strength, to get out of the way. And which are some of the ones that we named?
Right. So, well, let's take a look at some names right now. Halliburton. This one has a lot of headline risk because of its continuation of the lawsuits with BP.
Well, Halliburton, you know, that's how quickly composure changes. We talked 3 to 6 months ago, these stocks were making new highs. They broke uptrends, and now they're breaking to the downside. Guys that were seeing the weakness in the OAH just said, let me take some of the components and try and short them, or at least not be long them. If you look at Halliburton, it makes sense. Halliburton broke. Look at this. This broke support yesterday, well before the spiders and the diamonds are trying to, and well before the Qs are just pulling in with the RTHs. So this has been a spot. This is why I hate stocks under their moving averages. I hate stocks near lows when markets are bouncing, because relative weakness doesn't lie. And Halliburton, to me, is a big time avoid. And once it broke this area, that was your way out, or at least when it broke 45. Look at this long-term support. People say, "Oh, how come I didn't sell this thing?" I don't know why, but when it broke support, that's your answer. Now people are shorting it. So just learn how to deal with these things.
Moving along to Schlumberger, broker Guggenheim took down their Q3 estimates yesterday due to some expansion concerns that they're having in the Middle East.
So these guys are earning their paycheck. They're taking down their estimates now when these stocks are on their lows. That's great. I'd rather them do it into this trend, do it and look forward versus add fuel to the fire to the downside. And Schlumberger also, this thing crushed. Lower channel, cascading lower and lower, low, higher, low, higher, low, higher, low, under all the moving averages. Why wouldn't it break support? So now, you go to the daily chart, this too looks a lot lower. And if you check out the weekly to see where potentially it could hold, I would say this stock can get to 55 before it's worth another look at some type of support. But right now, it's trending lower and it's starting to accelerate. You need to be careful with all of these, and even BHI. I think we should just get away from this group because they're just so weak, they don't even deserve your attention.
All right, so that's the oil sector space. We don't like that. We don't like Halliburton, Schlumberger, or Baker Hughes. So let's move on to quick hits for some quick cash, starting with everyone's favorite to hate right now, Netflix.
Yes, well, I think the quick hits title is very important. Because as a trader now, you need to be in cash because it's king. The only thing I'm going to be looking for in this market are quick hits, quick trades, both long, both short, until we get into a better environment. And Netflix has been crushed. It broke its uptrend 3 different times, and now it's given back 2/3 of its entire move in the past few years. So Netflix tried to show a little relative strength yesterday when the market was getting weaker, and I mean a little relative strength. So I guess today, some might look at it on the daily chart to trade it versus this low here. It's already through it. I'm going to see if I see a divergence. I'm not going to be crazy. I'm going to be very light. Maybe it goes green just for a cute trade, but the stock is broken. Look how it broke this uptrend and this one, and now it's just a cute trade.
Let's spend some time with Apple. We spoke about this on Tuesday for our Options Profits video. It's a name that we play every day, all day long. It's moved significantly since Tuesday, and we've spoken about a lot of levels intraday with OP on Real Money and also with T3. So let's take a look at.
Well, Apple has to be on every trader's radar today because this could show us if anything could hold in. And when Apple was at like 420 or so, Brent said, I'm going to cash. And people are like, what do you mean? We're never going to be able to buy Apple back again. I'm like, even the best stocks, after being up 7 days, you could trade the ranges. And now it's opening around that previous 52-week high. So if you look here at Apple, I'm going to look I'm looking for opportunity today because I was somewhat prudent and I sold into the strength. And hopefully some of you guys did as well. So now this is what you look at with Apple. This is the prior high, 404.50. Before we walked in here today, this is where it was trading. So I'm going to look to see if I could nibble here. If I see the futures go lower, Apple hold here, I think you could buy a little bit. But if it doesn't hold here and the market continues to cascade lower, I do think we could get to this 395, 392 area, which I would feel a bit safer buying versus this shallow pull-in. But Apple has been the best of the best, so that's why you have to have a few different strategies in place. 404, and then that 392 to 395, and maybe even 388.
Right. So, again, there could be another opportunity for some investors to pick up a couple shares when they ask how much higher can it go. There could be a great opportunity today, tomorrow. Let's move into Las Vegas Sands. It's another name that we talk about.
Well, Las Vegas Sands on Tuesday pushed through the highs, pushed through 50, and came back below, gave you an outside day. I feel like I sound like a broken record, but you have to learn these things because this is how you could trade your positions. You could have sold into that, and we talked also yesterday on how maybe it could test the uptrend. So if you look at LVS, you will see, this was what I was talking about, this push-through failure. You could have read about it off the charts also. after a big move down from 36, it pushed through. Then on Tuesday, it tried to go higher, went below the previous high, so that's your sell signal. So if you lightened up, if you're still in macro 1, I think you're okay. I think that there's going to be an area to buy back. Today I'll look to see if it can go positive. If it can't, significant support's around 45. The uptrend is around 46.50. So look to see how this area holds. But when this uptrend does change and it breaks below it, like we saw just say in SINA, I'm not saying it's going to happen here, that's why you take notice. Look at this. SINA broke this uptrend. Your stop was 104. If you did so, you just saved yourself about 14 points, and it's even opening up lower. I'm just throwing a few other names too because I'm really upset here. The guy's not following the rules. Tried to break through above 149, failed. This was your stop when it broke this uptrend, and now this could work its way down to 130 to the moving averages. So, when you're playing these type of stocks that are strong, you need high-level stops. And I don't care what quality the stock is. If the markets are all going down, there's going to be pressure. So
let's move on to GLD then. The market got hit yesterday, as did GLD, which is not a good sign for this ETF.
Well, gold you would think would have been like the safety play, right. but maybe because Uncle Ben is saying that it could be a long period of time, people are thinking maybe deflation versus inflation. I don't know. I'm just throwing that out there because if we're going to be that slow and demand's going to be that low, you see copper going below, you see oil lower. Oil could probably get below 70 in my opinion. And now with the GLD, one area to watch here. I drew this yesterday. This was support. I was hoping it would open up flat so we could have shorted it through this point, but obviously, nothing happens the way you want it. I would watch the 50-day moving average around 69, see if this holds, and if it does hold, perhaps, it's still okay considering the move that it had. If it doesn't hold the 50-day, there you go. This low here is 165.88. So gold will be very important to watch. If you're still in tier 1 long, stay with it. Hopefully you took off that trading tier because we've been saying it's a very weird time for gold right now because it's a push-pull on whether it's going to make new highs or correct. At this point, it seems like it's correcting.
Right. And finally, let's round it out with TLT. After the Fed announcement, that soared. And if that continues to make a move higher, that's not good for the market overall.
Yeah, that actually was going and breaking higher the entire time, even before the market decided to go lower. The TLT, big-time breakout yesterday. I didn't trade it, but I was using it as a gauge. Just gave you some clues to sell some more stock here. This is a clean break. At this point, it's hard to get in. It's had such a big move, but keep watching this for potential market direction.
So even though ugly tape, there's always an opportunity as long as you recognize your patterns, you're playing the range, you're looking for relative strength. We're going to look at Apple, Las Vegas, Netflix, GLD, and TLT to continue to trade. So we have a lot of headline risk out there. Again, like we're always saying, like you're always preaching, keep your position size tight, be nimble. Walking away for 20 minutes is not something you can do.
That's something to do, especially if you're holding a lot of positions. So you have to treat your stocks as if they're your kids. You have to monitor the action. You have to watch what's going on. You have to see when they're not behaving well. You have to see when they're overly excited because they might have had too much sugar. Anyway, besides the point, we are in dangerous times. So what I think is most important is just knowing your time frame, knowing your skill set, and knowing what you can handle. Because you have to expect the unexpected when it comes to systemic risk. It's like this is not a normal time right now, and right now the market's starting to play that catch-up game, and it can go down quick. So keep your size down. Hopefully you're in cash at this point. I think cash is king. We have some levels to watch. If you sold into strength early this week, congratulations, you're learning. If you're sitting in cash, you could be a sniper. Look for some quick hits back and forth, but do it small. And then once we get into a better environment, better tape, different patterns, there'll be a time and place again where you could hold 4 to 8 to 12 positions. But right now, you need to be close to cash and just taking an in and out approach and make sure you stay out of harm's way.
Okay, great advice. Thank you very much. I'm Jill Malandrino, and that's your morning call.